Lemoy. You're all heart. Well, I'm very glad to be here and presenting to you all. Although we're not in person, but this is the next best thing. You know, as an entrepreneur, and if you have the entrepreneurial mind, when when a crisis hits, you don't panic. You just pivot, and this is what we've been doing over the past year. We just pivoted, and so we've actually become more busy over the last year during a pandemic than ever before. So let me just share my screen with everyone, and so hopefully we all look the same. And so, yes, I'll skip through this, but yes, on top of what Lemoy was saying, yes, I also helped start a community center here in Mississauga. It was called the Gateway Center for New Canadians. It recently closed, but it was at the corner of Central Parkway and Wolfdale. And we just started a ministry, and our ministry is to help build and support churches. Actually, we just had our first church plant last night, and we have a Portuguese pastor that is going to be the senior pastor for this church. So we helped her get her started, and that is just the one of our plan is to actually have 100 to be grown across Canada. So I don't know if everyone's Christian, but anyways, that's where I've been for the last 25 years. And so the impact, of course, of this pandemic has really affected a lot of people, mostly in the service sector and the airline industries, the tourist industry. And I myself have lost friends due to the pandemic. But the financial aftermath of this pandemic has caused people to have past due bills, you know, and when that happens, your credit rating can go down. And also, we don't want to get these things like final notice, especially if it's your utilities. That is very hard. But rest assured, there is help for people that really need it. And I'm going to share some of that with you. So my background, I did graduate from Brock University with a business and economics degree. I did study for my master's of business administration in the US in Michigan. When I first got out of university, I did work for a real estate company because I always wanted to work for myself. So I didn't know what was good. I just chose to work in real estate. And I was only 21 or 22 at the time. And then I was headhunted by this company to work as a manager for a general and financial services firm. It's actually one of the largest brokerages in across Canada. And I also got my life license at this company. One of my biggest accounts was a hospital. I actually insured the entire hospital. That was a big account. And then I did my certified financial planning designation. I also was a consultant to CIBC, as Lemoy had mentioned. And these are some of the companies we represent. I'm not gonna focus on any particular company. I just want this to be very generic, but these are the companies that we work with. So these are companies at our disposal. And the best thing is we can cherry pick and pick the best products on the market today. If my picture is kind of blocking, you can always move my picture to the side. So this is what we call the X curve. When we first start out in life, on the left side, we're generally less secure. And so we have a lot of responsibility when we first start out, but we don't have much wealth. So we have a lot of responsibility because we have a lot of bills. You know, we have cars and payments, maybe a new mortgage on payments. We have bills to pay. We have children to raise. So we're generally less secure. And so over time, we build wealth, and you see how the curve goes up and the responsibility goes down. So senior citizens, of course, they have less responsibility, but generally they have a lot more wealth. In fact, the baby boomer generation is the richest generation in the history of the world. In Canada alone, about $1.6 trillion will be transferring hands from the baby boomer generation, which is anyone born between 1946 to 1964 is a baby boomer. So I'm just at the tail end. And this is the richest generation, which will be passing their wealth onto the next generation. I hope some of you that are on this call are going to be one of those. So, and feel free to, use your reaction button. If you like what I say, you could click the smiley sign or the laughing sign, if you find it funny. But the difference between when we're less secure and more secure, to fill this gap between these two lines, sometimes we have to fill that with insurance. For example, if you just had children, and heaven forbid, if you lose your parents, the children loses their parents, it's devastating, financially devastating. And like Shania Twain lost both her parents at the same time, and she had to raise her siblings by herself. So that needs to be covered through insurance. It could be, doesn't have to be life insurance necessarily. If you're single, could just be disability insurance. That we never know when these things happen. Stuff does happen, accidents do happen, and at least you can be provided with an income should that happen, or even critical illness insurance. Should we suffer a critical illness? And the main four are heart attack, cancer, and stroke, and bypass surgery. So the next one is, has anybody heard of the Rule 72? They can come off mute and tell me if they heard of this mathematical rule called the Rule 72. No? Okay, so nobody learned this in school. I don't know why they don't teach this in school, because Albert Einstein, who was one of the smartest minds in the world, he actually found the power of compounding. And he found that if you take the number 72 divided by the interest rate, gives you the number of years to double your money. So let me show how that works. So when we put our money in the bank, how much interest does the bank give us on a savings account? Anybody know? No? Well,
I think it's less than 1%.
You're right. Who's our smart person here?
Tfsa.
Okay, well, yes, it's less than 1%. It's actually, depending on the bank, 1/4 to 1/3 of 1%, which means, let's say if you just get 1%, if you take 72 divided by 1, that's an easy one, of course. 72 divided by 1 is 72 years. It would take you 72 years to double your money. Who's going to live to 101? Well, maybe Hazel McCallion will. But the banks are giving us a very low rate of interest, and they think that they're doing us a favor. They're actually doing us a disfavor. Does anybody know what the inflation rate is? Approximately? It's just a little over 3%. So if you're putting your money at 1%, are you making money or losing money? You're losing money, yes. So at 4%, if you were to get 4%, actually no banks are giving 4%, even in a GIC. At 4%, 72 divided by 4, your money would double every 18 years. And when you hit 47, if you were 29, any 29-year-olds here today? Anybody close? Okay, Sonia, I'm gonna declare you're 29 years old. Okay. So Sonia's 29. and she put her money in. She put her 10,000 in, and in another 18 years, she has 40,000 age 65. Sonia, could you retire on 40,000? No, that might last a month. At 8%, money doubles every 9 years. 72 divided by 8 is 9. So every 9 years, your money will double. And when you hit 65, you double your money to 160,000. Could you retire on 160,000, Sonia? No, that might last maybe 3
No,
years.
no.
No, not 3. Because if you're making 40,000 a year and you have 160,000, that's only going to last maybe 4 years at the most. But when we put the money in the bank, what does the bank do with our money?
They use it
They use it, they invest it, they
invest it.
loan it out.
For themselves.
Yes, and they give us loans, credit cards, mortgages. How much do these charge us on a credit card? What are the two main credit cards out there? There's Visa and
MasterCard.
MasterCard.
Yes. Well, there's a scripture that says the borrower is a slave to the lender.
Slave to the lender.
So who's the master? MasterCard.
Yeah.
Yes. So the banks, they can make at least 12% on your money because they're charging you almost 20% on a credit card, are they not?
Yep.
So 12%, 72 divided by 12, the money would double every 6 years. So here you are. Here's the bank. They take your 10,000, they invest it, they make 12%, and when you're 35, they made 20,000. When you're 41, they made 40,000. When you're 47, they made 80, 50, 360, 59, 320. And when you hit 65, they made 640,000. If you only made 4% on your money, you get your 40,000 at age 65. How much profit did the bank make? The difference, 640 minus 40. 600,000. Whose money was it to begin with?
Mine.
It was Sonia's. So
Yeah.
it's her money. It's also your money. It's also my money. They're taking our money and making money on our money. And that's how the banks get rich. When you drive downtown Toronto, you drive down Bay Street, you're looking at all those tall buildings. Who owns those buildings?
The bank.
Yeah, TD Tower, BMO Tower,
Yeah.
RBC Tower. Who built those buildings?
My
The-
money.
Yes, your money. Your money. You should go claim a brick at
Yeah.
least.
Yeah,
Yeah.
at least.
So but the best part is you can make the money the same place where the banks are making it. You could make 12% on your money. Don't stick it in the bank, earning next to nothing. So when we invest, we don't, of course, we don't want to risk our principal. We don't want to risk our money. We want it to be relatively risk-free. But there's a concept I'm going to teach you here. Now, let's say you buy this investment. Let's say it's a stock or a mutual fund, and they sell it as units. Let's say it's $10 per share or $10 per unit, and you have $100 to invest. And if this investment's going down like this, would you invest in a fund that's going down like this, or a stock going down like this? No. Most people would not. But let me show you how this is going to work. If you invest $100 and it's $10 per share, you can buy 100 divided by 10 is you could buy 10 units or 10 shares. Okay, it goes down to $5, so it's lost half its value. And now you're probably panicking because you lost half your money, you think. Now you could buy 20 units because 100 divided by 5 is 20. If it goes down to $2, now you're really panicking because you think it's going to be wiped off the face of the earth. 100 divided by 2 is 50 units. And if it goes down to $1, 100 divided by 1 is 100. And if it stays at $1, 100 divided by 1 is 100. And if it goes back up to $2 per share, how much did you invest? $1, $2, $3, $4, $500. 500, and it increased in value. Now you have a total of 280 units. So if you multiply 2 times 280, you made $560. If you sold that stock or that mutual fund at $2, you would have still made $60 profit. Is that amazing?
Hmm.
Now, the best part is, let's say it goes back to where it started at $10 per unit, and you have 280 units. 280 times 10? Anybody?
2,800.
2,800 for a $500 investment. Wow. You know, recently in the news, there was a stock called GameStop. Or, yeah, and it was, if you would have bought that stock a few months ago, it was like about $5 a share. If you would have sold it a couple of weeks ago, if you had $10,000, you would have made, I think it was $6 million. Yeah, at the peak. Yeah. Yes. But you know, so the best part is you can make money while the market's going down, and it did go down, and I'm going to share that with you. So, and this is actually called dollar cost averaging. Okay, so this is a very amazing principle. You know, you do it and you don't even know you do it. When you go fill up the gas in your car, when the price of gas is high, what do? We put in 10 bucks, 20 bucks. But when the price of gas is low, we fill up our tank. Yeah, so we already do it already. Yeah, we also don't put all our eggs in the same basket. So we don't invest just in one particular investment. We diversify. And it's like an elevator. So if this guy gets on an elevator and there's only one cable holding up this elevator, if the cable snaps, he's going to fall to his death. Same thing with investments. I won't say you're gonna, I wouldn't say that you're gonna have hundreds of different stocks, because that's a lot to manage. But if you diversify enough that you diversify in different areas, in different sectors, there's bonds and equities, and there's global equities, there's specialty funds. Like one of my favorite funds is the Global Healthcare Fund, which invests in pharmaceuticals. And right now, everyone is getting the vaccine. So these stocks of these companies have to go up because the government are paying top dollar for the vaccines for it to be distributed. And I think there's about 5 major companies that are doing that today. So we diversify. So this is like a mutual fund, and a mutual fund is just a collection of different investments. Not everyone is a savvy investor that knows how to play the stock market. So you could just invest in mutual funds, which will give you the diversification, so that if a few companies go out of business, you're not going to lose your money, because it's going to be professionally managed by a professional investment management company. And so if these companies go out of business, the ones marked with an X, like Kmart, ESPN might go out of business because it's in sports, and who's watching sports these days. Restaurants might go out of business, like this one is called Chili's. So it pays to be diversified. So we don't need much knowledge to start investing in a mutual fund. It's diversified. It's flexible, easy to buy, sell, and trade and exchange. Hundreds of funds to choose from. In fact, there are about 5,000 stocks in North America, but there are over 10,000 mutual funds. Believe it or not, there's more funds than stocks. So you can really cherry pick and pick the best ones out there. But I know it's a lot of work to do. So that's why financial planners like myself, we scour the market to find the best funds on the market today. And so you could register them as a RSP or TFSA. Does anybody know the difference between RSP and a TFSA? Okay, so an RSP is based on your income. So 18% of your income. So if you made 100,000, you could actually contribute to the maximum that you can purchase on an RSP, which is 18%. So there is a limit. Now, not very few people actually hit the maximum. So if you just invest $10,000 in an RSP and you're in a 40% tax bracket, for your contribution to the RSP, you'll get back 40% as your tax refund. So that's 4,000 if you invest 10,000 added back to your tax refund. Okay, or if you have to pay taxes normally, then it's deducted from the taxes that you owe. However, when you take the money out of your RSP, you're going to be taxed. When you take the money out during your retirement, you will be taxed on every dollar you take out. So really, an RSP is really a tax-deferred loan back to the government. So you're going to eventually have to pay it back. Because what do most people do with their RSP tax refund? You know, they spend it. they spend their tax refund. And if you reinvest it, then it makes it advantageous to invest in RSP. A TFSA, you don't get a tax deduction, but your money grows tax-free. And when you take the money out, it's also tax-free. So when you take the money out for retirement, hopefully you're going to have a lot more money in retirement than you do today. And you can take out all the money out of your TFSA tax-free. Currently, right now, your TFSA maxes out at, if you never contributed, to about $76,000. If you never contribute to a TFSA, because it accumulates every year. Right now, it's $6,000 added contribution room to your TFSA each year. It used to be $10,000 per year before Justin Trudeau took power, because Stephen Harper raised it to $10,000. But when the Liberals came to power, they dropped it down. And just recently, because well, it was an election year when he raised it back up to $6,000. Okay, or it could be these also could be purchased as a non-registered fund as well, which means that it's not an RSP and it's not a TFSA. It's what they call an open investment. Okay. Disadvantages of mutual funds is no guarantees on performance. Past performance does not dictate future performance, subject to market gains and losses. Non-registered funds may be subject to capital gains taxes. I won't go into detail about that, but just so you know that there are taxes to be paid if it's non-registered, and will be subject to probate taxes if the account holder should pass away and it's not credit approved. So if you owe money to someone, your creditors could take the money. Okay. But there's a better solution to this. So here's two dummies driving a car. And it says, would you drive your car without wearing a seatbelt? No, we wouldn't. Would you drive the car without an airbag? No, we wouldn't. We want to make sure we have those safety features. And there is funds today that we have that have the safety features should the market go down. So why would you invest without a safety net? Okay, so this is one of our funds that we have that has the safety net that we can actually guarantee your principal, and we can actually guarantee, heaven forbid, if the person should pass away prematurely, we can guarantee up to 100% of your investment. So I've been using this fund for the past couple of years. It's been doing pretty good. BlackRock is the fund manager. BlackRock is the largest investment or asset manager or mutual fund manager in the world. Um, they know what they're doing. So if you invested here, it invests 27% in information technology. Can you think of the companies that where they invest in information technology? And the second one is healthcare. Okay, just to give you an idea. So this was the performance in 2019 was 21%. 2018 was a bad year. 2017 was okay year, it was 10.46. But you know, for in 2020, in a pandemic, this fund actually did almost 30%. And so if you invested 10,000 in this fund in year 2010 until the end of 2020, you would have had $47,000 in your fund. And you see where it invests? Apple is the number one company, Microsoft, Amazon. Who's been buying from Amazon here? I think everyone, right? Facebook, Google, Berkshire Hathaway, which is run by Warren Buffett, one of the most savvy investors out there today. Johnson & Johnson, they have a vaccine out right now, Procter & Gamble, and Visa, okay? So you see the long-term performance, 13% over the last 10 years. So at 13%, your money would double about every, let's see, 13, just a little better than 6 years, okay? So that's still a pretty good performance, right? And so this is Warren Buffett. He always sits on a pile of cash. He's actually sitting on a pile of cash. Why? He's waiting for the market to melt down. And he capitalized on this last year. So the market went down. When did it go down last year? It actually went down in March 2020. He took advantage, and he had over $100 million of cash, and he bought all these stocks cheap. So this is the Dow Jones. The Dow Jones is it's an index which monitors the 30 largest stocks in the U.S. And at the end of in the middle of 2020, it hit 22,000. Sorry, at April 6th, 22,679. So what this measures is the stocks going up and down. So actually that stock went up 1,627 points, which is 7.73% that particular day. There was a market jump. So, because remember, the market went down in March and then it started climbing back in April. Did you know if you would have invested here, you would have made a pile of money. And right now the Dow Jones is over 31,000 points today. Okay, so before we can know where we're going, we have to first know where we are today. Okay, would you agree with that? Okay, so this is something we do. It's called the financial needs analysis. It's just like when you go to the doctor and the doctor is going to check you inside out, going to check your vitals, going to check your blood pressure, your heart, and so forth. If you're not healthy, what does the doctor give you? A little piece of paper, and you take that piece of paper and you run to the pharmacy and get it filled, right? Now, did the doctor charge you anything? No, well, we have OHIP. But the doctors just told you what's wrong with you and told you how to remedy your health situation. So this is called the FNA. We do the same thing. So if we provide a recommendation to you, then it's up to you if you want to fulfill the recommendation to increase your financial well-being, or whatever the difficulty might be. It might be, you want to get out of debt, for example. And in our FNA, we also include what are your objectives? What are your goals? what will make you happy? What are your dreams? And we all have dreams, don't we?
Mhm.
And we want to fulfill those dreams, but we have to have a plan. And so how much on a monthly basis could you contribute towards your plan? So I've heard this just recently from another person. Says, well, from our income, we give 10% to God, we give 10% to ourselves. We pay ourselves 10% on everything we make, and you can also give, if you want, another 10% away to charity. Okay, so if you live within your means, you'll never be in financial trouble, and you'll always have enough money to fulfill your dreams at one point of your time. So we do what we call this needs analysis. First, we find out what are your expenses, because we have to know what's coming in and what's going out, and how much can you have left over, and we can pinpoint the problematic areas where you might be having difficulty. Okay, right now a lot of people have huge mortgage payments. The average house today in the GTA is over $1 million. Your first time home buyer today is almost 40 years old. If you take a 25-year mortgage and you are 40 years old as a first time home buyer, how old will you be when you pay off that mortgage? You'll be 65. You haven't started saving for retirement. So I'm running to people like this all the time. They're in their 60s and they have a $400,000, $500,000 mortgage. And I ask them, when do you plan to retire? And it's, oh, I'm going to retire back in Barbados. Okay, that was the actual answer from one of my clients. Okay, so and then we analyze what your expenses are, and where the money is going. Do you have student loans? Maybe some young people have student loans. Actually, if you invested in RSPs, you could actually take out your RSPs and not pay any taxes on it on when you went back to school. That's one strategy. And if you do have children, we want to know, do you have an RSP? If you never had an RSP for your child, you can get $500 to $600 right off the bat when you start your RSP, free money from the government. And you just have to contribute $50 and you get that $500. And if you're in a lower income, you can get $600. Okay. And plus the government will give you 20% on every dollar you put in. So if you put in $1,000, you get $200. And we want to know about your debts, okay? And everything, when you speak to a financial advisor, everything is confidential. We cannot even tell your parents or anyone else about your situation. I actually have I had a situation where a client, a couple, they're from Jamaica. I was just telling Lemoyne, they hadn't told me they had $65,000 of credit card debt. When our debt counseling firm had talked to them, they actually had $95,000 of credit card debt. And so they were able to reduce their debt instantly from 95,000 to 19,600 just through the stroke of a pen. And the creditors took a bath, but my clients would have never have paid off those credit cards because they kept building up, and they were spiraling down this abyss of debt. And so and I know her mother, and her mother doesn't even know. Okay. So and we also want to talk about what protection you might have. So heaven forbid, if you lose your life or become disabled or have a critical illness, will you be able to get back on your feet, or your family get back on their feet should this ever happen? And recently, one of my friends who is a pastor in Brampton actually passed away and left behind his family because of COVID. he lost his life, and his wife was in hospital at the same time, but she could not plan our funeral until she got out of the hospital, and so he had to stay in the morgue for over 3 weeks, and every day they charge you money for every day. And if she would have talked to me, I actually could have had all that arranged while she was still in the hospital, because we do have a company that does all the arrangements on your behalf, and they will negotiate with all the funeral homes to get you the best rate and act as the concierge service on your behalf. So becoming financially independent, first of all, requires discipline. Okay, and this is the definition, and this is really a something we have to develop as a habit. Have the financial discipline. You know, when you see something you really want to buy, do you really need it? You have to think about it. Don't be so impulsive. So if you delay your decision making for a day or two, chances are you might not buy it. Okay. And of course, when we look at clothing, clothing will never look as good as it does when it's on the rack. When it's in your closet, it does not look so attractive, right? So I know we love clothes. Okay. And we all have dreams. So a lot of people actually, they pursue their dreams, but sometimes they give up much too easily. And people will try this and they'll try that, they'll try this and try that, but they lack the discipline and the persistency to see it through. If you can, because when you start a business, it actually takes a few years before you can actually get the hang of it, because you're learning as you go. And a lot of people stopped short of hitting the diamonds on their journey to financial independence. And dreaming alone doesn't work. We need to have a plan, and we need to have the discipline to go along with it, and we must be consistent. Stay the course. Be consistent with your investing, consistent with your saving money, and we need to develop good personal habits. Okay, you know what the biggest nation in the world is, which has the most population? It's not a country. It's actually procrastination. A lot of people procrastinate on their personal development. They think, oh, do it later. I won't learn this. We'd rather watch Netflix rather than watching something educational or reading a book. In fact, the average adult today reads less than 2 books per year. We need to develop those good habits. How to develop ourselves to be a better person, not necessarily smarter, but making better decisions, because the decisions you make today are going to affect you down the road, maybe 5, even 10 years down the road. Okay. And of course, there's successful people here. This is a fabulous movie, The Pursuit of Happiness. This is a guy that actually became a stockbroker, and he started with zero knowledge, but he had a dream to raise a son. So we all, of course, want to be a millionaire. Actually, you will be a millionaire in income, because if you only make $40,000 a year and you're 25 years old, by the time you hit 65, you would have made $1 million. However, for someone starting out in life today, any young professional, by the time you hit 65, because we are living in the highest tax country in the world, actually number 20, the 20th highest tax country in the world. We are the 10th highest indebted nation in the world, believe it or not. You can Google it. Our highest tax rate is 53%. That means more money is going to taxes than our pockets. Okay, you will pay over $1 million just in taxes alone for a young person starting out by the time you hit 65. Okay, so you need to have more than $1 million tucked away by the time you retire. Some good books to read. No Excuses, How to Win Friends and Influence People, because you know we all need to deal with people. This book called E-Myth is a fabulous book on entrepreneurship. What this book talks about, E stands for entrepreneur. What it says is 95% of all businesses that start fail. They all fail in 5 years. They're kaput. They're done. And what this book talks about is don't invest all your money and all your time and everything to start a business only to have it fail, because that is a big setback. I had a business where I actually failed and I lost a lot of money. It took a while to recover, and so I learned my lesson. Okay, and of course, one of the best-selling books in the world today, and still a bestseller, is Think and Grow Rich. It's somewhere just behind the Bible. Okay, so it's a great book by Napoleon Hill. It was written in the Depression years. So it's been around for almost 100 years. Okay, so these are books to read. Now, if you go to Google, you could go to Google right now if you'd like. If you type in the best industry to become a millionaire, maybe someone can do that. Maybe if someone could take a minute and type in Google, the best industry to become a millionaire, what is that industry? And someone can come off mute and just blurt it out.
It said financial services followed by technology.
Yes. Now you know why I'm in this business. It is true. And the company I'm with has created more millionaires than any other company out there today. And if anybody's interested, I'm a trainer with the company, and I will teach you my 28 years of experience I have in this industry and show you the road. But I will tell you, it's not an easy road. But for those people that want to pursue this as a career choice, it could just be part-time for now. But if you want to become full-time, yeah, I would not give up my job unless I was making more income from my part-time than my full-time. I'm actually thinking of a guy who was a rocket scientist. He's actually in our company, and I know him quite well. He gave up his rocket scientist career to join our company, and it's going to be a while till he makes more money than we used to make, but he loves it. Okay, I think he was bored of his job, and anyways, maybe he wasn't launching so many rockets in space. But yeah, so this is the industry. Okay, so that's it for me. So thank you very much for attending, and it's been a pleasure to share it with you. I love sharing with people. I love caring for people, and this is why I'm in this business, to help people. And it's the best business where I could do what I love to do to help those people to get financially sound. And because I know that the number one reason why couples divorce today is because of money issues. Okay, so thank you, Lemoy, for having me, and thank you everyone for attending.
Thank you so much, Darrell. That was very, very informative. I took some nuggets of wisdom for myself as well. I just want you to speak a little bit, Darrell. Time is almost far spent, but if you could speak a little bit about credit card management, because I know that that is a sore point for a lot of individuals. What are some of the best practices you would say in terms of using a credit card?
Okay, great. Okay, so if you buy something on a credit card, let's say this computer I'm using today, let's say I bought it for $1,000. If I never pay off the balance, I just pay the minimum payment. In 3 years, I will have paid double for this computer. So credit cards, of course, are charging you 19.99% or no, 18.99%. And if you miss one payment, they're going to bump up your rate to about 25%. Okay, now, so for those people that have been accumulating balances on their credit cards, if you're in a position that you don't think you'll ever pay off this balance, I can refer you to one of our debt counseling companies that will they can write off 80% of your debt maximum. Okay, I'm not saying that if that's going to happen with everyone. If you can manage the debt, you can pay it off on your own, and you can. The only way it really is to save money to pay it off on your own. I would take the highest credit card that you have. Now you have to measure against your maximum. So never go over 80% of your maximum. So if your maximum is 10,000 on your credit card, do not go over 8,000. The reason why, you will start to erode your credit score. So you must maintain a credit score of over 680 points. So a really good credit score is in 750, 800. Those are really good. Now, the credit score makes a big difference when you buy a car and when you buy a house. If you are below 640, they'll give you a leeway between 680 and 640 on your credit score. And if you have certain banks on your online banking, you could actually get your credit score for free. Or you could actually write to Equifax. If you write them a letter and you send in your ID, they'll send you back your credit report. Or you could pay the online $20 and get your credit score right away. Or you can go to Credit Karma, and what's the other one? Geez, I forgot. Anyways, you can get those credit scores.
Borrowell. The other one is called
Borrowell. Yeah, that's the one. Yeah. But I would not subscribe on a continuous basis, because every time they hit your, it's kind of a bother, they keep, because now you're on their mailing list, and you're going to get your email is going to get bombarded with all kinds of spam. Okay, so so that's one of the catches. Okay, so if you can maintain a credit score over 640 minimum, but best over 680, when you apply for a mortgage, you'll be considered what they call you will go to an A lender. So an A lender is like a bank, BMO, TD, and they'll give you the best rates on your mortgage or whatever loan you're taking out. If you're below 640, you would have to go to a B lender, which means a higher interest rate. And this is what's happening to a lot of people that buy homes today. They're going to B lenders and paying 7, 8, 9% on a mortgage. And then, using rule of 72 divided by 9, interest doubles every 8 years. So you're going to be paying a lot more for that house. Okay. And of course, yeah. And when the realtors are going to be doing a total debt service ratio on use. So that means that the amount of debt you owe is going to affect your ability to purchase a house. Okay, so if you have a lot of debt, it's going to affect your purchasing power of this house. So the best thing is start with your highest credit card and start to work that down on a regular basis. Never miss a payment, whatever the minimum payment is. If you're going to be late, make sure you call the credit card company, say you're going to be a few days late. Okay.
All right. Thank you for that, Darrell. I'm just going to open the floor. If anyone has, I think we could take one question that you would like to ask.
Anybody? No?
Don't be shy.
We
Sorry,
could say,
yeah, I have a question.
Yeah.
So for the investments that you spoke about,
Mhm.
what would be the best investment right now outside of a mutual fund, or what company you think it's the best to invest in right now
Okay.
that will make money right now?
Okay. Well, that fund I was just showing you, the one which is managed through BlackRock, okay, is a good one. It's the BlackRock U.S. Equity Fund, but I wouldn't purchase it as a mutual fund. I have a company called IA Financial, and they will actually add the guarantees to that fund, which means that if the fund goes down, they will actually guarantee your principal. If there is a maturity date, okay, and on the maturity date, they always guarantee your principal, as well as they've also creditor protected as well. And at the same time, the best thing is what they call resets. Okay, so this is how a reset works. So if the fund goes up, let's say you invested 10,000, and let's say 2 years later it's now 15,000. So you've made 5,000 on that fund. So now it's $15,000. You can lock in your growth at 15,000. So if the fund goes down again, you're locked in at 15,000. And you can keep doing that. So if it goes up again, let's say to 20,000, you can lock in at 20,000.
So if you want to talk to Darrell, or you may have some questions that are unanswered from tonight, Darrell is very gracious. He will be willing and able to provide you with that information. And his number is in the chat. You could grab it from there. I really want to thank everyone for coming out tonight and for showing up. It is appreciated. I want you to continue to share the word and spread the word as to what we are doing. Next month is going to be another wonderful presentation. We're going to be talking about the art of networking, and I have a very brilliant presenter, just as Darrell, who is going to come and share with us how is it that we're supposed to be networking, whether it mean in person, or a lot of the networking that is happening now is being done virtually. So we need to know how we're going to be able to network, because that is going to take us to our next level. So thank you. And as you know, what we do here before we go is to say a prayer, if that's okay with you. If it's not okay with you, then of course, that is also respected. But thank you so much for showing up. I know that I have folks from Jamaica as well who are here. Thank you, my Jamaican folks. And of course, those who are in Canada, thank you for coming. And of course, my folks from the US, thank you for showing up as well. That is appreciated. So if you don't mind, I'm just gonna pray briefly and then we could say our goodbyes. Lord, we just want to thank you for the ability that you have given us to connect. We want to thank you for the power of knowledge. And I just thank you for Darrell's life, that you have blessed him in such a way with knowledge so that he could pass it on to others. We thank you for the information that we have received tonight. And I pray that we will be good stewards of the resources that you have given to us. Lord, we ask that you will bless the works of our hands and you will help us to gain wealth, Father. Father, you wish above all things that we prosper and be in good health as our soul prospereth. So I pray, God, that whatever we use our hands to do, I pray that the works of our hands will be blessed, and so that we can be a blessing to humanity. Be with each individual, be with each family that is represented here tonight. Let there be no lack in our lives and in our businesses. We give you all the glory and the honor. In Jesus' name we pray. Amen. All right. Good night, folks. Thank you so much for coming.